So that jumps us into the next slide here, John, talking about flexible qualifications. I think you spoke very well to this information.
This is one of my favorite topics
yeah.
because
Yeah. So
I'm going to
tell
you guys. I'm going to tell you guys something. One particular thing in this that it generally really surprises people. So let's start with the minimum credit scores. They have been bouncing all over the place since the forbearance was announced, and they've come back down to earth a little bit. Our minimum score is 620. They were headed up towards 680, but the Federal Housing Finance Agency suspended the servicer from having to pass through the payment whether they received it or not, which took the sting out of forbearance, and the investors have begun to drop their FICO requirements again. So we'll be back to normal soon. And again, with this, as you can see on the screen, bankruptcy, 2 years, 1 to 2 years with extenuating circumstances. Divorce is not an extenuating circumstance with the VA, but there are certain times, maybe it was health problems, or I think in a couple of years, we're going to have a lot of 1 to 2 year bankruptcies because of the pandemic and people getting laid off and people having to go into forbearance. Foreclosures also are 2 years. Most places, I think FHA is 3 years. Fannie Mae, I swear it's 120 years. I do not want anybody that's ever had a foreclosure. Now, here's the item I was telling you about. Short sale, Fannie Mae and FHA treat as foreclosures. VA does not. VA, there is no time frame after you've had a short sale. You can have a short sale this week and go and get a VA loan next week. They treat it as a collection settled for less. Now, don't have a short sale and then go and try and buy a house a block away. That's, if you short sold because the neighborhood just couldn't hold the value and then you're moving to that same neighborhood, that's not going to work. But if you short sold because you got transferred and you had to sell your house and you had to move cross country and you got transferred from California to Lebanon County, and now you're buying a house in Lebanon County, but you had to short sell your house in California, that's not going to hurt you. You're still going to be able to do your VA loan now without any time frame. As long as you, of course, somebody said to me, well, what happens if you didn't make your payments and you had to short sell? Well, then you're not going to credit qualify. Right. Your credit's going to be ruined for not making your payments. So that has nothing to do with time frame on a short sale. That has to do with credit qualifying. Right. So, but a short sale will not hurt you. And another difference with the VA loan, and I love it when I hear, well, your ratio is over 50, so we can't do it. VA does not go by ratio. They go by residual income. So it's a net income loan. It's not a gross income loan. So we have done several loans in the 60s and a few in the 70s, but they've had enough residual income left to qualify. And that's how we go. VA is an interesting agency. The VA Home Loan Guarantee Program works. Not all the departments of the VA work well. And as a Vietnam vet, I can speak to that. I've had my disability claim in for years and have heard no response as of yet. So, but the Home Loan Guarantee Program works really, really well. Their sole existence is to assist the veteran. Let's say you don't quite meet the residual income qualification. You're a little bit low. But we'll take a look at some factors. Okay, what's the credit history? Oh, credit history is excellent. Okay, that's good. Long-term employment, that's huge. Significant liquid assets is really huge with VA. We'll take a look. What's the payment difference from what you're paying now and what there's not much payment shock. Okay. And we'll take these into effect and we'll go ahead and approve the loan, even though you're short of residual income. Because we're looking for stability on the part of the borrower, as opposed to some magic number. The VA doesn't have a magic number. The whole handbook is not written black and white. The whole handbook is written gray. And the VA gives the lender an awful lot of latitude in making decisions on behalf of the veteran. There's another thing. As realtors, I'm sure you've had some lenders in the past say, avoid the VA loan at all costs. The VA is impossible to work with. Well, let me tell you something. The VA has nothing to do with loan. They don't even know there's a loan until the loan is guaranteed, and the lender even issues the guarantee. So the lender does everything start to finish. So if a lender ever comes into you and tells you the VA is impossible to work with, what they're telling you is, I don't know how to do them and I don't get paid if you give the loan to somebody else. Well, your obligation, your fiduciary responsibility is to your borrower, not to that lender. Make sure you're giving your borrower, and this loan, I'm telling you folks, is the best loan on the planet. And it's a benefit that your borrower has earned. Let him use that earned benefit to his, and it will be to his benefit. It's a tremendous, I've used mine 5 times. I have it on my current house out here in San Diego. And it's a great program. So,
very good point that you make, John. I just want to reiterate that the lender makes a huge difference. I can tell you, from experience, I can speak to that as well. I have, had my share of, being on the listing side of things, and, the buyer comes to you already with a lender in hand that they've been working with, or, just working with another realtor, that comes with the buyer, and, they're using a VA loan, or they want to use a VA loan, and the lender really has no clue. So, I can't by law steer anybody, have to be careful of that, but always try my hardest to recommend, Andy, or a lender that I have worked with and had success with and never ever have a problem with. And, it's just, that can make or break the transaction. It absolutely can, to have a lender that knows what they're doing, like Andy, that can just, he makes it too easy, and the difference when you end up with a lender that doesn't know what they're doing, because it can be a little painful for sure. But I agree, there's a lot of misconception out there about VA loans, and we'll get into that a little bit too when we talk about the home specifications, which is the next slide that we're going to talk about. Because that's one of the things that I hear as well, when I get out there and I'm talking to buyers and, asking them, when we start to talk about financing, are they a veteran? Is there a possibility of having access to, a VA loan? And I've heard the reaction that, oh no, I hear that that's, really hard, and there's too many hoops to jump through. Or when I'm talking to sellers, listing their property, about the possibility of a buyer coming to them with a VA loan. Oh no, I hear that those are just a nightmare. A lot of misconception out there, but I can tell you, it is really not as hard as some people make it to be.
It's an easy loan.
Yeah. And
it really is.
Yeah. The lender, as well as the realtor on the other end, can make a huge difference for sure.
Well, there's one other huge advantage of the VA loan program, and it's a huge advantage to the real estate community. And that's the fact that it's a fixed rate, assumable loan. Rates aren't always going to stay this low. We're spending, we have a $3 billion or $1 trillion coronavirus bill that's passed. That's going to have to be paid for eventually. And the Fed funds rates are going to be going up. So let's say 3 years down the road, you have a 3.25% VA loan, and these people are moving and they're not going to use their VA again. Somebody can come in and assume that 3.25%. They're going to put 20% down and get a conventional loan. Maybe that same 20% they could put down and assume we'll take it down to the balance and assume that existing VA loan. And if it's a veteran that's assuming it, you can do a substitution of entitlement and your seller can get his eligibility back. It's a great tool. How much more would that be worth to you as a listing agent and to your seller if in a 6% market, somebody could assume a 3.25% loan?
Yeah.
That's worth a lot. Or in the event that somebody inherits a home with a loan on it, the veteran passed away and his kids inherit this house, they can let somebody assume that loan. That VA will never be used again, and they can get additional. They could get additional funds for that. So that's a huge advantage to you in the real estate industry, as well as to the veteran who's buying the home.
Question on that. So for instance, if you have the VA loan, we want to use that assumability as an option. If they haven't maxed out their entitlement, can they leave that entitlement with that home, let someone else assume it, and go out and use the remaining entitlement?
They can go out and, yes, they can go out and use the remaining entitlement that they have, correct.
I thought, okay.
Yeah.
Okay.
And now, if for any reason the people that assumed that house ever refinance it, then your seller is eligible to get all of his back because he'll meet the requirements off the loan, not a title.
Right.
And doesn't it, John, doesn't it also, it's probably important to mention too, that the person assuming that loan doesn't necessarily have to be a veteran.
Does not have to be a veteran.
Right.
That's when the entitlement will be tied up. If a veteran assumes it, then we would just do a substitution of entitlement and the entitlement won't be tied up and the seller can get a brand new VA loan. Yeah. Anybody can assume a VA loan.
Great.